Welcome back to Investing Talk Podcast.
Today we're looking at onsemi.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And the big picture narrative for onsemi, it's a really classic study in proving your structural strength while you're trying to navigate a cyclical downturn.
Okay.
For you, the most important takeaway is really this shift from contraction to stabilization. We saw Q3 2025 revenue come in at about, what, $1.5 billion?
And that was down year over year, right? Which is expected.
It was down year over year, which is that cyclical headwind everyone in the semiconductor space is facing right now. But the crucial point, and this is key, is that it was up 6% sequentially.
Sequentially, so compared to the last quarter.
Exactly. That sequential acceleration is the first piece of hard evidence that stabilization is really taking hold.
But the real story isn't just the top line. It's what they did with the bottom line. But hold on a second. How can revenue be struggling year over year? I mean, that sounds like market conditions are tough.
They are.
But their profitability is holding up so well. Isn't that, I don't know, a sign of potential underinvestment or something?
That's an excellent question, and it speaks directly to their structural change. They managed to post a Q3 non-GAAP gross margin of 38%.
38, okay.
And an operating margin of 19.2%.
Right.
And when we talk about non-GAAP margins, we are essentially, stripping out temporary charges or accounting noise to look at the core sustainable profitability.
And getting almost 20% operating margin in a down cycle.
In the middle of a serious semiconductor down cycle, yeah. It's incredibly telling.
So why is that happening? It sounds like they've fixed something fundamental.
Exactly. It confirms that the deep operational work management has been executing, we're talking about things like portfolio pruning and fab optimization, is paying dividends structurally.
Okay, so portfolio pruning just means getting rid of the low margin stuff.
It means systematically selling off or discontinuing lower margin commodity legacy products. It lets them focus resources purely on high value, high margin specialized chips.
And fab optimization is just making the factories run better.
Incredibly efficient, yeah. Improving utilization, leveraging newer processes. This isn't a cyclical fix. This is a permanent lift in the company's inherent earnings power.
I see. So they're choosing quality revenue over quantity, and it's showing up right in the margins.
Precisely. They didn't just stabilize, they executed with financial discipline. That efficiency helped them deliver Q3 non-GAAP EPS of 63 cents, which significantly beat expectations.
And what about the outlook?
Well, you combine that with forward guidance for Q4 that kind of brackets what the analysts were expecting. It strongly suggests that the bottom of this cyclical correction is, well, it's likely in the rearview mirror.
Okay, let's move from resilience to growth then, because the structural story rests on the engine room. Automotive has always been their declared core.
Absolutely. The automotive segment continues to be the primary engine of structural growth, and it demonstrated continued strength even in a tough environment. Q3 auto revenue was up a solid 7% sequentially.
7%.
Quarter over quarter.
Hitting $787 million. That kind of growth shows that the demand for their next-gen components is sticky and accelerating despite broader inventory corrections.
And that growth is driven by highly specific high-tech areas, right? We're talking about things like EV traction inverters and AD sensing.
That's right.
For those of us who aren't automotive engineers, can you just unpack those terms quickly?
Sure. EV traction inverters are essentially the brains of an electric vehicle's powertrain. They convert DC power from the battery into the AC power needed to run the motor.
And efficiency there is everything.
It's everything. It directly impacts the vehicle's range, which is why specialized high-performance power chips are so critical.
Wow.
But AD sensing is, well, it's the advanced driver assistance systems, the cameras, radar, LiDAR that let vehicles see. So everything from lane assist to full self-driving.
Exactly. These are complex, data-heavy systems that require precise, highly efficient sensing components.
Okay, so they aren't selling standard processors. They're selling these highly embedded components for the most complex energy-critical systems in the car. That sounds like a powerful, competitive moat.
It is a critical moat, and that's what's so fascinating here. onsemi isn't selling commodity chips that are easily swapped out. They have a specialized portfolio in intelligent power and sensing.
And they work directly with the car makers on the design.
They engage in system-level co-design, which means they work with the customer, the car manufacturer, at the earliest stages of the vehicle platform development.
Can you give us a relatable analogy for that? for that system-level co-design and the high switching costs that comes with it.
Yeah, absolutely. Think of it like this. If you're building a custom high-performance race engine, you can't just buy a generic spark plug off the shelf.
Right, you need something specific.
You need a specific custom-tuned part that works perfectly with your unique engine block. So once onsemi's component is designed into that EV platform, it's extremely difficult and expensive for that manufacturer to switch to a competitor.
Because you'd have to redesign and recertify the whole system.
The entire system, potentially affecting range and safety ratings. That long design-in cycle and high switching cost, it translates directly into protected long-term revenue.
Got it. So they're building these incredibly long-term, sticky revenue streams, even if the macro environment is shaky. But it's not just cars, right? The industrial segment is showing some powerful signals, too.
Absolutely. While auto was the biggest story, the industrial segment is an accelerating structural tailwind. Industrial revenue was up 5% sequentially to $426 million.
And that's in areas like factory automation and aerospace?
Factory automation, advanced inspection, aerospace, and defense. All high-growth areas.
But the number that really jumped off the page for me was the signal regarding the industrial image sensor funnel. Up a staggering 55% year over year. What does that funnel growth actually mean for their future?
That 55% jump is essentially their future sales pipeline for industrial imaging chips. It's an order book that hasn't been recognized as revenue yet.
So it's a leading indicator.
A massive leading indicator.
Yeah.
It points to compounding demand for high-performance imaging, which is the backbone of advanced automation and machine vision. As factories get smarter, they rely on these complex sensors. It points to a multi-year growth runway outside of just the EV megatrend.
That helps connect the dots. So if we pivot to the bigger picture, AI, it's moving from being a headline narrative to an actual scaling business segment for them. How concrete are those numbers?
They are surprisingly concrete. Management expects their AI-related revenue to almost double year over year in 2025. Almost double, reaching nearly $250 million. This isn't just a hypothetical growth area. This is a rapidly scaling vector tied specifically to the power and sensing needs of modern data centers and edge AI.
So they're selling the high-efficiency wiring for the AI revolution, basically.
That's a great way to put it. AI requires immense power, but critically, it needs that power delivered with extreme efficiency. onsemi's components play directly into that.
Which is a clear market opportunity. Now let's talk financial health, because structural growth is great, but flexibility is key during a downturn. They're described as cash-rich. Can you quantify that?
They are remarkably cash generative. Q3 free cash flow, or FCF, was $372.4 million.
And FCF is the purest measure of a company's health.
It's the cash remaining after covering all your operating expenses and capital expenditures, yeah? It's what you have left to pay dividends, buy back shares, or invest in growth.
And their FCF margin was 24% of revenue? Wow, that number feels really high for a hardware company.
The 24% margin is absolutely top tier among their peers. And it validates that high margin capital discipline model we discussed earlier. It tells us two things.
Okay.
First, their product mix shift is working. Second, and crucially, they are running a structurally asset-lighter model.
Structurally asset-lighter, that sounds like corporate jargon. Translate that for us.
It just means they're being extremely thoughtful about capital expenditure, or CapEx. Their CapEx remains tight, at only about 3% of revenue in Q3.
So they're not building massive, expensive factories all the time.
Exactly. They're avoiding the trap of aggressive, massive factory construction that can burden chip companies. By being asset lighter, they can generate strong cash flow relative to their asset base, making them more flexible and resilient.
And that cash flow isn't just sitting idle. They've been returning it to shareholders.
They have. They bought back approximately $925 million in shares year to date. That's essentially 100% of their free cash flow.
Which is a massive vote of confidence for management.
A huge vote of confidence. And they have substantial total liquidity, about $4 billion, giving them immense flexibility.
Now, we have to look at the risks, because no story is perfect. What's the main bear view right now?
The primary risk remains the inventory correction that's still playing out. Analysts are concerned that this cyclical weakness, especially in auto and industrial, will cause a revenue decline of maybe 15 to 17% for the full year 2025.
That's a significant headline number. So how do we distinguish that risk from a genuine structural collapse in demand?
It's largely considered cyclical, not structural. The decline is a necessary correction after the massive overordering during the supply crunch of 2021 and 2022. It's an inventory issue.
Not a fundamental rejection of the megatrends.
Exactly. The market is just digesting the excess supply, which sets the stage for a healthier demand environment later.
And the resilience we saw in the margins and free cash flow. That acts as a powerful mitigant against that risk, right?
Yeah, it does. The 38% gross margin and the 24% free cash flow margin mean they have a wide buffer. They can generate tremendous amounts of cash even when the top line is pressured.
So they can keep investing and buying back shares.
Right. And while there was a headline recently about some routine insider selling that was significantly outweighed by institutional accumulation, one major fund acquired over 167,000 shares.
Which signals what the so-called smart money is thinking. Okay, so if the operational discipline is the foundation, let's talk about the market's reaction.
The market has certainly started to reward the execution. We've seen the shares climb around 9% over the past month.
Just a nice recovery?
And crucially, they surged 11% in a single session, following news about their financially disciplined expansion plans. This outperformance suggests investors are buying into this strength. It's a constructive shift in momentum.
So what's the next major catalyst that you, the listener, should be looking for to validate this thesis?
The immediate next test will be the Q4 results. Those will be absolutely key to validating that stabilization thesis. We need to see continued sequential growth, or at least firm confirmation of the bottoming process.
And updates on the AI business.
Tangible updates on the scaling AI business, making sure that $250 million target is on track, and the continued expansion of that industrial sensor funnel.
And looking macro, the eventual clearance of auto and industrial inventories is the biggest catalyst of all, isn't it?
It is. The normalization of those inventory channels sets up a massive positive inflection point. Once the excess supply is digested, we should see strong volume demand return. But this time, it will layer that demand onto a structurally more profitable business.
So what does this all mean for the takeaway?
It means ON Semi is a high-margin, cash-generative leader focused squarely on critical megatrends: EV, AI power, and industrial automation. They've proven their structural integrity through this deep down cycle.
Which positions them for outsized leverage when demand comes back.
Exactly. The current risk-reward balance certainly appears to skew favorably toward a multi-year re-rating, driven by structural, not cyclical growth. This raises an important question for our listeners. How much of the risk associated with the cyclical downturn do you think is already fully reflected in today's valuation, especially given the proven resilience of their cash flow?
Thanks for joining us for this analysis. If you found this useful, please hit subscribe so you don't miss our next analysis next week.